What you're telling me is that music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism. 1974, 1987, 92, 97, 2000, and whatever we want to call this. It's all just the same thing over and over. We can't help ourselves.
I say when we sell. Hey, I say when we sell.
All right, we're back near all-time highs. This week we sat down with Tyler Neville. We discussed a number of topics. It was an engaging conversation, enjoyed it quite a bit. We first started with the generational divide and the policy distortions that Tyler has lived through in his career, post-Great Financial Crisis to the present day, and the dynamic playing out between short volatility and long volatility, and ultimately why you need to own scarce assets and be long volatility to preserve and grow your wealth. We also got into the topics of the AI productivity shock, what that could mean for labor markets and financial markets going forward. And then toward the end of the conversation, got into Bitcoin Treasury companies and institutional appetite for these companies, as well as spot Bitcoin directly. And then at the end of the conversation, we had a little bit of an internal rip. Brian, Michael, myself, we had some interesting takes, I would say. Brian and Michael came out swinging for the fences for the end of the year and into next year. So you want to stick around for that one to hear where they think this is all going and ultimately what the price might look like. And if you're bullish Bitcoin, if you're long scarce assets, if you own Bitcoin, then you really need to have a plan for securing it for the long haul. And that's why you may want to speak with OnRamp. We focus on multi-institution custody. What that means is peace of mind for you, your family, seamless inheritance built in without your family needing to know how to manage devices and seed phrases. You also have insurance, Bitcoin-backed loans, Bitcoin IRAs, quite a bit being built on this foundation of multi-institution custody. So if you're not in touch with us already, reach out to onrampbitcoin.com. I would love to speak with you. All right, we are back. It's the last trade. Got Tyler Neville, and we're joined by Brian and Michael from OnRamp as well. Tyler, thank you for joining the last trade today. How's it going, man?
Going well, man. It's getting less hot here in Austin, so I'm enjoying the weather finally.
Tyler, excited to have you. We were curious about how you feel about Jackson's wall art because it's been commented that it looks like he's in a cave, and so we're trying to work, help him level up the podcast appearance. Curious if you have any recommendations.
Yeah, I gotta roast you, Mike. Look at what do you got going back there? It's nothing special either.
I know. I at least had something on the wall, so I felt good. I just got back to Texas. I'm in a office that we have here in Wimberley, and it's going to be revamped. I got nice art, but I just got to put it together. I got back late last night, so it's been a little bit difficult. Jackson does not have that excuse. Yeah. He just likes to look like he's in a cave.
Yeah,
I love when it blows up in Michael's face. It just happens. It happens every show. He'll never admit it, but it does.
Jackson makes up for it with it. Look at that, the golden locks, long flowing hair.
No background needed.
You don't need a background with that hair, baby.
I love it. Well, Tyler, man, this is going to be a fun one. You kept us waiting. We wanted to record with you a couple months back, and life happened. So this is even more highly anticipated show than it originally was. And so been really enjoying your takes recently the past few months on X. It's where I follow most of your work, but then also your podcast with Forward Guidance at the Blockworks team. But why don't we start? It's a really big topic, and so take it however you'd like. But you write a lot about just the policies and the macro forces that have really driven a generational divide, particularly in the United States, and would love to better understand just over your career, the policies that you've observed and the forces at play in the markets that have ultimately led to this massive concentration of wealth with boomers, inability for millennials, Gen Z to afford homes, to marry, to have children. I think this ultimately gets at a lot of when you dig into the financial system, it really explains a lot of these trends. So I'd be curious to hear what you've observed in your career and how you ultimately categorize all of this.
Sure. Yeah. I guess the easiest way to start is I started in 2007 at this firm called KBW, it was an investment bank that just covered other banks. So you figured out how the hell banks worked. This was only my first job out of college. And I was doing like financial modeling for all these like regional banks right before the financial crisis hit. And you essentially see like as people stopped paying their mortgages, you saw non-performing assets just go skyrocketing. So these banks were essentially like walking zombies. And I realized at that point, you know, KBW was one of the first banks to actually say like it's going to be a bad recession in 2008. And then I realized across the street, Wall Street, no one actually knew how the system was made. It was literally just a bunch of people pressing buttons and making shit tons of money, excuse my French, and they had no idea how the banking system worked. And so like, I don't know, I became a little too obsessed with it and read a bunch of books about how the monetary system was made, et cetera. Historical books of like fiat paper currency, you know, Sovereign Individual, those types of books, The Ascent of Money by Neil Ferguson. And I basically realized that like it's after 79 when Nixon got off the gold standards, it's just a money printing Ponzi scheme backed by debt. It's really hard to actually say that in an institutionalized setting like these investment banks. But that whole premise of just like feeding debt and just debt fueled growth hit its denouement in 2008. And then everyone I realized didn't know how the system was made. So that basically formed the basis of all this stuff. And after 2008, we've basically been in the same money printing scheme for the last, 17 years. It's fascinating to me that no one really realizes it. Like we've been diluting our currency at like an exponential rate. But if you actually say that in an institutionalized setting, like they don't really want to hear it. But that's essentially the backbone. We can go anywhere from there, but where do you guys think we should go from there?
Maybe you could just expand a bit on from 2008 to where we are today, like the proverbial can kicking that has occurred. Mm-hmm. As you referenced, like we've sort of just extended and pretended everything that we sort of instituted in 2008 in the wake of the GFC. Maybe just a little bit more color and detail around like what those mechanisms have been, what they're sort of evolving into in the current age, and kind of what you expect going forward as, there's a ton of pressure on the Fed, obviously, to cut rates into an environment where everything's at all-time highs. So that seems a little bit counterintuitive. Like curious, just, mapping from 2008 to now, those mechanisms and what you see today.
Yeah, it's just to simplify it, I think what it is it's the boomers don't want to take a haircut on any of their financial assets. And so they keep coming up with what I call the acronym factory, where if you go for the past 15 years, every single time there's a hiccup in credit markets, they come up with it's TARP, it's, LARP, it's whatever the heck it is. And they'll bail it out in 2 seconds and create some acronym to make sure the money markets are functioning fine and there's no credit problem. And that's been the backbone of the whole thing for the past 20 years, essentially. And it's all because boomers are heading into their latter years and they do not want to take a haircut on their assets, especially homes. Housing prices need to stay higher because that's the majority of their retirements.
100%. There was something that caught my attention, Tyler, on your X profile more recently. And it ties back into the original point that you made, where if you're existing within the institutional finance world, it's either people are dishonest or they still don't recognize the inherent foundation of the financial system and how this ultimately drives asset prices. But you had quote tweeted, I guess, a podcast interview talking about how, people who are, in this case, like a finance professor, but it really extends out until like what these people are taught in university, then they're taught early in their career. And then these portfolio construction ideas and theories that we've pretty much agreed to in this industry to be. And so now people operate under the false assumption that inflation is like 2 or 3%. If you're generating a 7 or 8% nominal return in your portfolio, you're doing great. But there's very little acknowledgement within institutional portfolios of the true rate of inflation, the debasement of the currency. And if you were actually to start measuring returns against that benchmark, the returns would look far less attractive across the board. So I'm curious what thoughts you have there.
Yeah. One of my favorite things was after 2008, playing not to lose in hedge funds was the really cool thing to do. So you had a massive boom in beta neutral hedge funds, meaning like, if you were long $100 of something, you were short $100 of something else. And if you could make 8% in that world, you were a genius and you could charge 2 and 20 and maybe 3 and 30. And, you know, if you just made money from that in up markets and down markets, you were great. But the problem with the whole thing was it just ignores like history and debt bubbles in general. And so if you actually do the math, say it's an 8, you know, Raoul Pal says 8 to 10% dilution in fiat currency per year. So that pretty much makes every single functional bond, you know, you're losing money every year by investing in bonds. Like if the high yield bond is right now, is yield to worst is like 6%. To buy the riskiest credit debt, you will still lose 2% in real terms against the dilution of the currency. So it really makes debt right now does not make any sense, because why the hell would any millennial and Gen Zer buy a bond right now? It does not make any sense because they just continuously torch the currency. And if you were to, when you say this in an institutional setting, they're like, well, you know, if you risk adjust it and you, it's been 17 years of this and these academics just still can't get their mind out of it. Meanwhile, you have the crypto bros who just absolutely have crushed it continuously year after year after year. And it's like a difference of the they mid curve it, all the intellectuals. But I think they're starting to realize, oh my God, there's really only 2 trades. You stay ahead of the fiat dilution through like, you know, fast growing tech stocks or frontier, I call them frontier stocks or space stocks or whatever they are, or you go to stores of value. Because there's no other way out of this thing. I call it the Ponzi scheme. You know, everyone makes fun of me for calling it a Ponzi scheme. There's pockets of real things happening, obviously, in the Ponzi scheme, but they continually see just never-ending dilution of your currency at higher valuations. But it's like this deceptive game just to keep the boomer system going. And I think what they're really trying to do is just hand off the assets in a more, it's like the Great Rotation. They almost called this the Great Rotation in 2008, except it never came. But it's a giant debt for equity swap. Like you slowly move out of the bonds. Boomers still will invest in bonds because they're mandated to, and they just hold the supply of the bonds is getting smaller and smaller as the boomers have more and more cash. And then that money slowly seeps into equity markets because they're the ones keeping the yields down with constant reinvestment through pensions, et cetera.
Yeah, it's a great take. I mean, it really ties back to the whole notion of sound money, or Bitcoin is more of a common sense test. And I think maybe we talked a little bit about the existing status of the world and the market inertia. And we see this across just legacy infrastructure in general. There's the market sentiment. It's hard to go against it. Calling bonds impaired. We talk to people at Fidelity. It's very hard for them to even discuss that, even though it's pretty straightforward. The math is the math. More curious, changing a little directions on this great rotation, because we naturally see this happening. I think there's been a calls for the dollar demise since the beginning in 71. I think what's different and where we potentially might be in a settling phase is really gold, because gold is this thing has been suppressed for decades and it's making its move. It's close to $4,000 a troy ounce, which is just absolutely insane. We saw what happened in Shanghai, we could talk a little bit about, and effectively different countries coming together that are going to start net settling oil, the commodity that underpins everything, in different currencies, whether it's, you know, backed by gold or in gold. Just curious how you see this rotation playing out into particular sound assets with gold and Bitcoin.
I don't know. It's like 40 years of breaking down institutionalization is like really hard to do. So I think it's just going to happen slowly and steady. We're getting into some sort of euphoria here in gold, and Bitcoin's starting to move as well. I don't know if this is going to be like, I think it's going to be slower because there's so many mandated things from the institutional world. It's like you get, you know, money from taxes goes up, the taxes go to pensions have to invest into these asset classes. So it's really hard to like rotate fast into all these things. It's just going to be this gradual, like slow default, I think, on a lot of the fiat bonds is my read. But I don't think it's going to be like you wake up one morning and it's limit up in gold and Bitcoin every single day for like months, and then the entire fiat system kind of folds.
I would generally agree with that, just in the sense that, you know, the 60-40 is so ingrained, as you mentioned, particularly with boomers and older generations, that they're not just going to hot swap out of all their bonds. Like, that's not what's going to happen. And I think you brought up a great point around the generational divide and the perception of debt markets, right? Because if you're someone younger, you're exactly right. Like, why would I lend the U.S. government money to receive a negative real return? Like, it's completely nonsensical to someone who has grown up in a world where the general trust in institutions has eroded at a pretty remarkable clip. And so like that's the big disconnect in my mind, is like it's this generational divide of people who have grown up in a world really post GFC, where the trust in institutions, the trust in government is maybe not at an all-time low, but it's on a steady decline, right? And so I think that is sort of a pivotal component of why those younger generations will opt for, they'll probably still buy equities, but they're not going to buy bonds, and they're increasingly going to look to Bitcoin as their digital gold portion of their portfolio. So I think it's a very astute observation in terms of, again, that generational divide in terms of, just how you perceive stores of value, how you perceive investments. And it really all comes back down to institutional trust waning, in my mind. Like that's sort of the critical juncture.
Yeah. As a side note, I used to trade at one of the largest 60/40 portfolios in the country. It was called the Franklin Income Fund. Is this $100 billion fund. Essentially what it was, is just like the boomer fund where everyone just plays not to lose. They just want their income every month. This guy that manages is absolutely brilliant. What it really is over time, he shorts volatility. He sells overwrites calls on the equity position. And what you really do is you're picking up nickels in front of a steamroller. And I think that synopsizes my experience with that is over a generation, when you're just looking to clip yield and you're not actually investing in new ideas, that whole product, I call it the short volatility trade in general, because like that mimics almost every baby boomer product, which is I want to clip yield instead of invest in something new, because I don't want the risk of investing something new. And herein lies the irony, is that over a generation, when you clip yields and you create more debt, you're just moving wealth from one part of the social class to another. So it's like you just annihilated the middle class through fiat printing and clipping yield. And tell me if I'm going down a rabbit hole here, but it's the same premise of insurance, where it's like Warren Buffett shorts volatility. He offers, he takes premiums in, he goes and buys bonds. And that whole mechanism that it's similar to the 60/40 is gone on for too long. And we're at the point where the secular stagnation is so bad because no one has invested in new things. Now the government has to make up the gap for the nominal growth that we need to pay off the debt, which makes the risk reward of going out in the risk spectrum like way better, because otherwise the system doesn't exist. You'll have like social discord if you just keep doing this clipping yield short volatility trade. So now retail's figured it out. It's like, this is what I meant by you go from a short volatility products to long volatility products, is like an easier way to explain it is back like 40 years ago, our grandparents had china, like the plates, and they would say, oh, you got to get a good piece of china. You're going to pass it down. And like, it's going to be a great store of value, this china. And then like you go in our generation, it's completely worthless. And it was not a store of value at all. It's the same thing as like bonds now for us is like, that's ridiculous. Like why would we ever own a bond? And so when I mean from going from short volatility is like, you created this whole risk adjusted return theory about how to invest in assets for 40 years. All these institutionalized people did it, but then they forgot to pay it's the most important thing, which is the dilution of the fucking currency. Excuse my French. And so now we're at this point where, because of the way the system is set up, you need to force nominal growth higher through the dilution of the currency and fiscal spending. And so that money has to flee into the new frontier assets to create the growth for the next cycle. And so we perverted risk-adjusted returns is sort of what I'm saying, is like you've pushed it so far where the risk now lies in owning, a home, and your wealth is generated in stocks, in frontier stocks now, because of this generational gap. And I had a good chart on Twitter about that, which is like, we saw the blow off top in home values. And now there's just like anything that's been used as leverage and squeeze the middle class is now an asset that will relatively underperform in this new, like next 20-year cycle. Sorry, I just rambled there. You guys tell me to shut up if you want.
No, that's the point of the podcast, right? That's why you're here. It's funny because it was timely. I was over at my in-laws a couple days ago, and my wife just found these Treasury bonds that were gifted to her when she was born. And so it's funny because, to your point, Tyler, China, right, as a store of value 40 or 50 years ago, It's the same idea as gifting, a newborn baby Treasury bonds 30, 40 years ago. And so now, like, you go to redeem a bond and, oh, it's a nice gesture. And the person who gifted that thought that would be, worth something today. But then you go to redeem it, it's like, oh, well, this doesn't actually, like, buy me anything.
Yeah.
And so it's interesting because a lot of this is generational, right? Investing and just a lot of things, I guess, in the markets are just human psychology. But in terms of how we perceive what a good investment is or what a good store of value is, a lot of it has to do with narratives, but then, of course, properties as well. So, like, Bitcoin is, like, partially a narrative, but also the objective monetary properties of it. And so I think, like, kind of ties into what you were saying, that generationally, both the macro and the micro, as well as technology and narratives, kind of inform what people perceive to be good stores of value. And so I am curious to kind of try to bridge this. How do you think about, like, the short volatility trade kind of coming to an end of the road where you have pretty much every asset class at all-time highs? I mean, some of the illiquid ones are starting to show impairment and pretty remarkable markdowns relative to what they were purchased like 5 or 10 years ago, say in commercial real estate, but still things are at all-time highs. Yet you pointed out that money markets are, there's a ton of cash in money markets. And so, like, how do you think about the fact that traditional assets are in all-time highs, the fact that younger generations want to own different assets than what their parents or grandparents owned, and the fact that there's so much cash on the table still? Like, does everything go up, or how do you think about markets in, like, the next handful of years?
I think it's a relative game where the Weimar Republic I bring up a lot because it's this extreme example of money printing where, your German currency was basically devaluing at an exponential rate, and you'd have to go get your paycheck and wheelbarrow it over and pay for your eggs. And I call it Weimerica now because I think we're in this relative game where the dilution is just going to keep happening at an exponential rate, unless, the caveat is unless AI is really massively productive and creates like a massive productivity boom, which is possible, very possible. But my point being is that in this world where you're constantly pushing fiscal spending, monetary spending, it's basically MMT is what we're doing. And in that world, there's going to be relative winners and relative losers. And commercial real estate is a perfect example of, like, oh, we thought this was, it was like a Thanksgiving turkey right before Thanksgiving. It's like, oh, it's great. This big fat building, you can charge all these rents. And then all of a sudden, like, boom, generational change. No one wants to go in the office anymore. We realized, why are we paying, why are corporations paying a 20% tax to the commercial real estate owners when we have all this technology where we can do our jobs anywhere? And then all of a sudden that Thanksgiving turkey is, toast. But a lot of the pension fund flows were funneling into that for a generation because it was risk-adjusted yield. But, like, if you vol adjust it, it's great return over 30 years, but then all of a sudden, bam, done. So, like, a lot of those types of assets where it's just a tax on someone else, and if there's a technological disruption, it really can go to the wayside. You're better off, like, ironically, investing in new ideas now rather than the stuff of the past. I mean, there's different. I would change my tune if the Fed all of a sudden decided to be like, tightening rates. Like, then you have to, adjust it. Or if credit spread starts widening and you need to get a little bit more conservative. But where we sit today, they're trying to delever the debt to GDP, which is, 130%. They need to get that down so that our deficit isn't so huge and we can actually grow our way out of the debt. So that's like, we're in basically wartime finance. They just can't actually say it.
Yeah, it's so true. We had Luke Groman on the podcast about a month ago, and we're talking about his idea of, you don't really, like, in wartime, you don't ask permission of the bond market to do something, right? And so the idea, kind of what you're describing as well, is there's a fiscal constraint now, and the Treasury market is, as we all know, heavily manipulated, and the Federal Reserve controls interest rates, and they're far below what the market would actually price them at if you have a country that is 120, 130% federal debt to GDP. In order to I guess where I'm going with this is, we're pretty much at the point now where there needs to be an acknowledgement that it is kind of like wartime, and you have to start intervening even more in the bond market, i.e. driving rates lower, purchasing more of the Treasury debt by whether mandating banks like the private sector or just doing it on the Federal Reserve's balance sheet. But ultimately, there just needs to be more and more intervention, which, to your point, I guess, will be more liquidity, faster dilution rate, and ultimately play into the store of tier assets more favorably.
Yeah, I think that's spot on of what's going to happen. The Acronym factory will do whatever. I call them the vol controllers in the Acronym factory. They will do whatever it takes to make sure the bond market stays calm and salubrious. And no one questions. It's like, you ever see The Dark Knight where he's like, it's all part of the plan. You know, they blow up a truck full of soldiers. It's all part of the plan. But kill one innocent person, everyone freaks out. And so that like you need to have it stay all part of the plan, and the bond market needs to stay copacetic. As soon as you get volatility in the bond market, like just get the hell out, because that ruins all the relative asset values. And that's the one thing I watch. Was that a good impression or?
It was pretty good, actually. One thread I wanted to pull on that you referenced earlier was like, this notion of the productivity miracle from AI. And I keep coming back to this because it's a nice story for people to tell themselves that like, oh yeah, we're going to grow our way out of this productivity boom, etc. I think what they're not handicapping is effectively what that forces the government and the Fed and the Treasury to do in response to something like that, which is actually print more money and dilute the currency even faster, because they can't afford that type of deflationary boom when they have this much debt. And I think that's a big disconnect that people are overlooking today. And one example of it is another acronym like UBI. Like if a ton of jobs are lost due to this AI productivity boom, there's probably going to be pretty loud screams for some form of UBI. And that dilutes the currency even further. So I think people are not handicapping this appropriately in terms of this theoretical productivity boom.
Mm-hmm. There's a great paper by this guy named Leopold Aschbrenner. It's called Situational Awareness. I don't know if you guys have read it, but he basically says there's going to be, as AI scales, there's going to be massive problems in the social contract, because if you have massive productivity, something you've never seen before, 1,000, 2,000% productivity growth, a lot of the people that capture that productivity growth are wealthier. And, the lower and middle income, you might have inflation come down due to the productivity growth, but, you might lose your job, right? Like you said, and you have UBI or something. So this battle is just going to be getting worse and worse. And there's a great chart. Do you know Infra? His name is Robert on Twitter. He put up this, he's awesome, by the way, does great macro work, but he put up this chart of like jobs jolts going down as the stock market goes up. And it's the first time they've disconnected. The line in the sand was when ChatGPT was actually created, and you saw like, now people are getting more productive. One person can do a lot more things. So I think I'm a believer in the AI productivity boom. I think it's going to create massive imbalances, and it's going to be, there it is right there. It's perfect. It's a good one. Like, right. See, look at that. Right as ChatGPT is released, jolts go down. And what's even scarier about this is if you're a college educated kid who just paid, $200,000 in student loans, and you have no real skill set. And I mean, I use Grok AI and ChatGPT all the time. It's frightening how like they can do what I used to do in a week in 5 minutes. So like this stuff is coming fast, and it's frightening. I don't know whether to be like happy about it or sad about it, but it's going to cause major issues, and like you have to protect yourself. And I mean, I think crypto is a way to protect yourself specifically, and the government, they're going to do some wacky stuff. The next 10 years is just going to be bizarro. But there's one thing that I think secularly works in that environment is the crypto ecosystem.
Yeah, I think two things to call out. You're exactly right. Like things are going to get insanely weird with AI, but the amount of energy required is just going to naturally be inflationary, because it's going to cost so much more for energy across the globe, which is going to help in that case for like UBI, because it's going to be very expensive just to like heat your home or like do anything productive. Where I end up coming back to, and I know this is jumping forward, but it comes back to what's the difference between savings and investing? Because I get like there's going to be a time between here to 10 to 30 years, but the rational decision is to save, not to invest, especially one, because it's an order of operations. You can't really invest until you have savings, but also because in this situation we're talking about, it doesn't happen in a vacuum. So as the amount of monetary units come into the system and people go further out on the risk curve, that means more things are going to naturally not work out. More things will, people are going to be left holding the bag, effectively zeros. And then you're going to start to look at what is the risk-free rate, and that ends up going back to gold and Bitcoin. And with these breakouts, I think nobody wants to catch a falling knife, but at the end of the day, like, wealthy people do not want to see their money be debased. And at a certain point, they naturally start to go in and out of, bonds and equities and say, well, like, look, it's just self-preservation, game theory. So I'm just curious, like, how you see that fitting in, because I know that there's been a really nice story for the past 30 years to kick the can down the road, but it feels like things are different, specifically because depending on where gold goes and the amount of sovereign bid, it ends up being the treasury or the reserve asset. We've already seen the amount of gold being held versus treasury. So these are just like different sentiments and different like inertia moving in a direction that we've never seen before, that I think kind of adds a different, like a wild card to a lot of the discussion that is just it's unknown unknowns effectively.
Yeah, the whole premise of what is saving in this world is just, for a brief snippet when Trump was putting the tariffs on and they were being like, they really wanted to shrink the spending and Doge happened. That was like, I might have to save my money again. The liquidity of the dollar system just like shrunk. Yeah, that was probably time to save your money. But now they did it. Now the charade is up and everyone knows that, oh, they can't stop this train. Like, they can't stop it. So our idea of what saving is, like, there was a great chart. It was like, median rents are going up higher than wages. Say it's like your rents are going up 5% a year, your wages are going up 3% a year. So you're becoming 2%, less wealthy every year just by, the rate of change in rent. And I think people are starting to catch on to that. Is like, God, my car insurance just went up by 20% this year. How the hell do I stay ahead of that? And this goes back to the Why America thing. Is like, this is normal in history for governments to do this. There's no currency backed by a government has ever lasted that long. And I think what's going to happen is the government's just going to place the dollar right alongside Bitcoin. And that will just be the way it can slowly devalue relatively. And then you'll have two different, monetary worlds. You're going to have the China-backed gold monetary world in Russia and India. And then you're going to have the futuristic 21st century crypto-backed dollar in the US and allied countries. And I think that's probably the most likely outcome here. But yeah, the premise of saving is just ridiculous. Like, the boomers can't wrap their head around, like, my wage not going up commensurately. It used to be like, oh, I make 5% more every year and it gets cheaper to live. Like, oh, this is fantastic. And like, it's the exact opposite now for pretty much millennials and Gen Zers. It's like, it's why they're not having kids. Like, assets are too expensive and, their debts are too large relative to their incomes. And that'll all change here, I think, where the supply of labor will shrink. Everyone's going to start getting paid more, and who's going to actually pay for it is the boomers, because they're all sitting in bonds and they're going to get smoked. All their pensions and all this stuff. It's just, when we get into office and millennials, Gen Zers get into office and younger, they're going to print money till the cows come home, because they're like, well, you fed us all this debt, but no one thinks past 5 years anymore. We can already see Mitch McConnell's gone, Pelosi's gone, all these old people, they're just going to be gone. And one of my favorite quotes is like, of this generation of the villains of the next one. And we're just going to see these people are going to be horrible. History is going to look upon them horribly when you see like the fertility of the next generation has been decimated by all these policies.
Yeah, the distinction between savings and investment, I think, is a very important one. And the reason it's not well understood today is a function of the past several decades, where subconsciously, most likely, like, most people are not conscious of this reality, but there's a subconscious notion that you can't save in dollars. Like, if you just hold dollars in a bank account, even if the individual doesn't exactly know why, they don't know the mechanisms or how CPI is calculated, they know that they can't just hold dollars in a bank account. So they're then forced to become speculators, effectively, become an investment professional in addition to their day job. And frankly, because there was no alternative, you could think about gold, but then it's hard to have a material amount of that in your possession, or know that your counterparty has the gold, et cetera. There's issues there. And so now that we do have Bitcoin as this opt-out mechanism for savings, we're still very early in people recognizing it as such is the main rub, right? Because people still view Bitcoin as very speculative, as an investment, as a technology play in some sense. We view it as savings, but most people do not. But that is, I think, going to be the important sort of education-driven evolution that we observe over the next few years, is people recognizing like, this thing is actually not speculative. It's actually the opposite, because it's actually the only thing I can trust going forward in terms of credible monetary policy and a finite supply. Now, how long that takes to actually pervade and manifest across society, I think is an open question. But that feels like the journey that we're going on is people recognizing that maybe I don't have to be a speculator and move so far out the risk curve and YOLO call options on Robinhood. If I can just save in a superior form of money, I'll outpace all this other stuff that would take time out of my day to become an investor. When I can just focus on my day job, focus on my life, my family, and just save money.
We recently launched On-Ramp Guardian. This is a feature designed to protect you and your Bitcoin against physical and digital threats. This is included on all on-ramp accounts. And so if you are thinking about social engineering attacks, $5 wrench attacks, people accessing your account through credentials, 2FA, etc., if you're just generally concerned about the security of your Bitcoin long-term, whether it is a digital risk, a physical risk, or it's both, get in touch. Like I said, this is included in all on-ramp accounts, On-Ramp Guardian. And there are a lot of different ways that this can protect you against the increasing sophisticated attacks that we are seeing every single day. So get in touch with us on onrampbitcoin.com, book a consultation if you're interested, and I would be happy to share more about what On-Ramp Guardian means for you. Thank you.
On that point, a derivatives guy, one of the really interesting things is everything is usually just a relative value in terms of volatility. And what I mean by that is if you look at the volatility in the S&P, it's like 30-day vols, it's like 8 or something. And that's come down historically because they keep trying to squeeze yield. You can actually manufacture equities into bond-like proxies with volatility by call overwriting or put underwriting, if that makes sense. I'm going down a rabbit hole, but you'll like where I'm going in terms of that. And what's happened to Bitcoin over time is the volatility of Bitcoin has kept going down and down and down and down and down. In fact, it's getting, in terms of store of value, everyone's like, oh, it's too volatile. It's actually getting less and less volatile. And it's a yield. Like if you generate yield, now you have yield generation type products on Bitcoin, which to me is basically, oh, you're creating Bitcoin backed bonds, right? That's what you're doing as the volatility comes down and the holder base gets more, wide enough to actually sell calls and sell puts and generate yield off your Bitcoin. You're creating a new financial system, if that makes sense, right? So relatively, would you rather buy a 6% high yield bond or, a 11% yielding, Bitcoin back? To me, it's a no-brainer, but it's all a volatility trade, right? So you smush volatility in boomer assets, but you have a little bit more to squeeze out from Bitcoin through the vol. But over time, you can kind of see the volatility as the adoption cycle gains. You see the volatility drop in Bitcoin, on the long term. So it's getting more secure, is what I'm saying in terms of that saving store of value.
Yeah, for sure.
Was that too far down the derivatives rabbit hole there?
No, not at all. I mean, it makes sense. It actually ties into something that I was curious to get your thoughts on. We have mixed opinions on the Bitcoin Treasury companies in this group here. And one of the things I thought that was interesting about how you've categorized them was relative to the junk bonds of the 90s in terms of new creation of product in the financial markets. Curious if you could just expand on that idea a little bit and share your thoughts. Kind of, I think you already did a little bit. If you want to share your thoughts in terms of how you perceive these Bitcoin Treasury companies in the space.
So I'm not a hater on them, and I can tell you why. So one of my old bosses is a guy named Mark Hart, and he's a macro OG. He shorted the subprime crisis in 2008. He bought credit default swaps on European debt in 2010, right before the default, the European sovereign debt crisis. He bought Bitcoin in like 2014. He's been on like every big macro trade of the past generation. And where his theology of investment is way different than like your PE ratios or your EV to EBITDA ratios. And he's like, how do people value art? Right? Like, how do you value art? And so you need to have access to the art. You need to have awareness of it. Like a Michelangelo piece is like, oh, wow, that's awareness, right? That's part marketing. You need to have a custody and security. You need to be able to borrow against it. That is a huge one, right? You need to have patina, which is like, it's got, chutzpah behind it. And then the potential for price appreciation. Those are 6 different attributes to any asset of why they hold value. And the one that really opened up for Bitcoin specifically was use as collateral. When you can borrow against something, it really unlocks a whole new ability for that asset to unlock value. Similarly, like the bad examples of it is when in the tulip bubble, you could borrow against tulips and buy more tulips and lever up, right? Like that was use as collateral that unlocked a huge price appreciation in tulips, but there was no utility behind it. But so my point being is like what Michael Saylor did was he used his balance sheet, borrowed money against it to buy Bitcoin. He created a Bitcoin backed bond essentially. And that moment unlocked a massive, and you could go back when I actually wrote about this specifically for Blockworks like years ago, but that was like the inception of what he's really arbing is the boomer system to the next generation system. It's a time arbitrage. You're basically taking money from all these boomer pensions, they're buying your bonds and you're putting it into this new system. So I don't really have a problem with the Treasury companies. In fact, you'll see in this if there is a next bull run, the Treasury companies can utilize lower cost of capital, can issue a high yield bond at 6%, go buy more Bitcoin. I mean, I would lever my company up, 10 times over, especially if my shitty software company is growing at 5%. I could use my balance sheet, borrow against it, and buy Bitcoin. So like the Treasury companies make a lot of sense. The only issue I have is if the government all of a sudden becomes like they actually want to normalize things and raise rates and inflation becomes a problem, then watch out. Like obviously that's a big issue, but oil's still at $60. Like look at all, they're figuring out ways to keep, the inflation at bay in a lot of senses. So I don't know. I'm very flexible on these things. Right now, it makes a lot of sense when you can borrow at a really cheap rate and put it in Bitcoin. But maybe that's not true if inflation actually takes off and they have to tighten, then it's going to cause a worse cascade. So like I can keep those two things in my mind at the same time as a trader.
I mean, I think that's an interesting way of putting it in terms of funneling in the dollars from the legacy system into the new system via credit markets or, in some cases preferred equity. I guess like where I stand with this is there's, in this space in particular, there's like a lot of copycats, especially in the past quarter or two. And there's this overarching narrative for the Bitcoin Treasury space that the critical role that these companies play is that the narrative being is, oh, well, people can't access Bitcoin directly for XYZ reasons, so we need to have vehicles to allow people to access through the fixed income and equity markets to Bitcoin. And what I've seen, and this is specifically for institutional investors as part of this narrative, but what I've seen in practice and in reality is the fact that the equity for the copy, for a lot of the smaller Bitcoin Treasury companies are owned by retail investors. And on the margin, the only real places you see any sort of institutional adoption of these companies is the strategies at a planet, like probably the top 5 companies where you actually see participation. And it's on the equity side, but I think more importantly, to your point, Tyler, it's on the the fixed income side, right? Because there's a lot of opportunity there, and that's kind of like where I'm at in terms of there's competing there's the narrative that I think they go to market with in terms of, oh, this is how you get $300 trillion of whatever fixed income capital into Bitcoin. And in reality, it's still really a retail phenomenon, and on the margins, you're seeing a little bit of institutional interest.
On the equity side, yeah, I kind of agree. I wouldn't particularly play in those pools, to be honest. MicroStrategy, I can't speak of single stocks. That that's a big enough balance sheet where you can do a lot of different things now. Like if your equity is undervalued, you could buy it. If it's overvalued, you can sell it. And there's so many mechanisms in the financial system. Like I don't think it's a bubble. If Bitcoin goes up by 100%, like a lot of those treasury companies, they're going to do better than a lot of other companies out there. So, and the interesting thing is that as their equity goes up, they can issue more equity, and it's like this self-reinforcing cycle into Bitcoin, if that makes sense. So I don't know. All I know is that if the credit markets were to shut off somehow, those smaller balance sheet treasury companies are going to be really hurt, especially because the retail investors are so pervasive in them. But yeah, on the whole, here's one other macro thing. Last thing is there's $7.31 trillion in money market funds. What does that tell you? That tells you that there's $7 trillion that's looking for yield, right? And so there is actually too much capital and not enough good ideas to put it in. When you think about that whole premise is like, as rates come lower, and those money market dollars seep out and go into other assets. Like we might be at the beginning of a cycle rather than the end of a cycle. Like you don't see that many people saving it's like a peak, $7.31 trillion in cash. Like you don't see that at the end of a bull market euphoria. I think you see the money market's cash coming down and forced into equities. And it's like, yeah, there we go. Which is just wild. Like that I would think it wouldn't be like that. But think about how much money boomers have that are looking for yield. It's why rates aren't spiking, right? They keep reinvesting it in yield assets and they don't even care about losing money because they're like, I don't care. I'm wealthy. I just don't want to lose my money.
Yeah, I think there's two core aspects. They're really hard to discuss because we live in a world where we're talking about outcomes that maybe are not here, but before, earlier in the call, are suboptimal, but they're relative because of the situation we're in that makes sense in a relative basis, in real versus nominal returns. And where the treasury trade gets a little trapped, and I agree, like we're still in the early stages and they're going to come back with a resurgence. And it's not because they're good products or needed, in my view. It's because of the relative situation we're in, coupled with everyone's effectively short Bitcoin. And if they understood that they were short Bitcoin, then they would be holding Bitcoin based on its CAGR and opportunity to grow in a risk-free view versus taking additional execution risk with a treasury company. And the way to underpin it is if you said every treasury company from here for the next, call it 36 months, will not go under. And meaning whether it's custodial risk, their own custodial risk, a lot of these are going to be generating or are trying to generate additional yield outside of some of the examples you said with leverage. And if none of them went out, then I could see it persisting. But what is going to happen, and I can promise you this, is that some will blow up. And they will blow up specifically because for 15 years, objectively, no net new financial product has come into Bitcoin and just succeeded tremendously. The last one was 2022, and everyone seems to forget BlockFi, Celsius, FTX. And then you can go back 2 years before that. You can go back 2 years before that. So this is just the next thing, and it's not to say it won't persist because, yes, every company should hold a better form of money on their balance sheet that outperforms everything else, and then they can just take market opportunities by acquisitions. But the notion that, the companies are buying Bitcoin to take leverage, it's well, the individual can either just hold the Bitcoin and risk-adjusted would outperform on a long enough time horizon some of these firms. And it's going to become apparent when some blow up because most they don't even really recognize that custody is a thing in Bitcoin. So they don't even know that that's actually an issue. And everyone, forgets the past 15 years of all of it. So I think it's just basically, if I had to encapsulate the treasury trade, it is effectively, opportunistically, I don't want to say taking advantage, but it is taking advantage of the early stages we are in the rest of the market's understanding of crypto or Bitcoin.
Let me ask you this question on that. I don't know if you own a house, but what's the loan you take out on your house generally? What do you put down?
Well, I got lucky. I have some property out here, so it got in 21. It was 2.3%.
Oh, you normally put 20%.
I thought you said the interest rate. Yeah.
What do you put down to? So normally you're 4x levered.
20%. Right? Yeah.
So when you think about, I don't know a lot of the treasury companies, idiosyncratic things, but if you're levered on your house, 4x, and these treasury companies are barely levered. I don't know, maybe, I think they're over collateralized rather than under collateralized, like relative to a house when you think about that. And if they have to stifle rates to grow out of it, maybe this could go along a lot longer. My point is that like we take a lot of leverage out on our own houses in terms of debt, and then we criticize it when they do it on Bitcoin. Like, I don't even think Sailor's that over levered relative, compared to like my own leverage on my house. You know what I'm saying?
I think it makes sense in a vacuum if that's all that was happening. But the problem is that as we get further with more liquidity and interest rates going down, these products will go further on the risk curve. And again, if we go back to relative base, somebody had Bitcoin or gold as their savings. And I think this is the problem as we look in the future of like where a lot of people have been and have benefited from just recognizing Bitcoins and gold are some of the best stores of value, if not the best, that it makes sense for a little risk capital, again, going back to investing, if you're going to park a sliver of your portfolio into something like this, and to your point, could use some returns on BTC. But that's not what people are doing. People are parking their Bitcoin sleeve in this, and then it's insanely volatile, and then they're going to get shaken out because withstanding Bitcoin's volatility, Bitcoin has objective properties that give it value. These other things don't have objective properties. They're subjective properties.
They're financial arbitrager machines.
Yeah, in a heavily financial arbitrage world that will be incredibly more chaotic and volatile, and to expect that it's just going to work out and you're going to make more Bitcoin or higher real return than Bitcoin this early in Bitcoin's monetization is the main point versus just holding spot. And the kicker is once institutions and individuals recognize that trade effectively compresses because it's just taking, again, advantage of the market's unsophisticated view of where we're at today.
But I agree with you, and I'm like very cognizant that could. Don't get me wrong, but I think it could also.
But it's like gravity. It's just gravity. It has to unwind.
A lot, but does it though? What if the government's past the point of? I mean, if this Weimar America type backdrop where they're constantly devaluing, like I don't know, maybe it's go for a year.
But
right?
You see, that's the big problem is this happens. That view is a similar view that a lot of people will say, well, if Bitcoin like just dollar hyperinflates, Bitcoin runs, nobody will spend their Bitcoin because everyone's going to hoard it. It's like that makes zero sense because if the price is running, people are going to naturally want it for goods and services, and they'll require people to spend it among other reasons. In the same view, the cousin is what you said, is if that world happens and we go to Weimar, that means that monetary units are getting pushed out at an exponential rate, meaning that capital is moving to ways that it shouldn't be and things are blowing up, and then people are recognizing what is the risk-free rate and goes back to savings. So this is unwinding all the mental fuckery of like the fiat system back to like first principles, and we can't expect people not to do that, and that's why we build like the way we build, because eventually people are waking up and they increasingly do, and they're like, well, wait, do I really want Metaplanet holding like my Bitcoin for additional, 20%? Or do I just want to hold the underlying and know that I can go to sleep and then I can just go back to being a doctor or a dentist or doing whatever I was supposed to do? And that's basically the renaissance we're on for the next 10 to 100 years.
I totally agree with that premise. Don't get me wrong. I was just like playing the mental game of like, I think a lot of this stuff is a pension thing where it's, I'm CalPERS. I need to put my money in, X number of convertible bond funds, and that money goes there. And then they buy some, Bitcoin backed convertible bond from a treasury company. It's that.
I agree. Keep going. Yeah, I agree there. The problem with that part is that's where a lot of the treasury companies are hiding behind. But the reality is, my understanding, only strategy and maybe Metaplanet are at a scale to access those markets, and so everyone else is just basically fleecing retail to sell them, higher performing Bitcoin.
That I agree with, and I'm sure they're just doing ATMs and like annihilating their equity and stacking, Bitcoin. But yeah, you make sure you do your due diligence there. I don't dabble in the lower tier ones, which I think is it's kind of a scheme, but more so like you can make up a lot of alpha if the underlying does go up. That was sort of my.
I do have a question on the institutional adoption of Bitcoin directly. Like, Tyler, do you have any thoughts on that? Because what I look at and Brian actually had an interesting chart where IBIT is now, what was it, the top 20 in terms of ETF assets? Yeah. But it's still like if you look at the 13Fs, it's still probably like 75, 80% retail owned. And then you have a lot of hedge funds in there. Not a lot of strategic asset allocations yet from institutional investors into Bitcoin. Do you think that that'll change in the next 5 years, or is this going to be are we going to continue to run up against barriers just from like gatekeeping and mandates that'll keep Bitcoin out of institutional portfolios for a while?
I think it's changing slowly. It's sort of like the demographic thing is all these mandates. Here's a great story. When I worked at Franklin Templeton, we sat around this big, it's like 50, 60 person oak table, and they were like a town hall meeting for the up and coming, younger generation. This is like back in 2015 or something. And I raised my hand. I was like, I think we should start a Bitcoin ETF. And every old person there, Jenny Johnson was the CEO. They all laughed in my face and were like, "You're an idiot." And my whole point is not, I told you so, but they did the Bitcoin ETF years later. It's more that these things from the giant institutions perspective take so effing long to like undo mandates that I think we're probably on the cusp. If we go on another bull run here, I think the walls will come crashing down, and they'll say, God, we got to do more of this stuff. And we've already seen it. Like Morgan Stanley has zero hash like embedded. A lot of these legislative pieces are going to this institutional money to be kind of allocated to it. But I do strongly feel that like I don't love the ETFs in terms of what they do to the market structure. Like IBIT being such a large piece of it. Like I really do love this decentralized nature where you hold your own Bitcoin. And at some point, if everyone piles into IBIT, like I don't like that risk. And I hope that naturally gets decentralized at some point.
I mean, that's what we're
You guys
focused on.
got to scale faster.
You're preaching to the choir there.
Scale faster. So anyway, to pump your tires a little bit.
Brian, I was curious on your thoughts. I don't want to toot our own horn too much. So I want to, Brian, get your thoughts on some of that information you did share ahead of the call, though, because there was the two notable things. There was the fact that IBIT is in the top 20 ETFs. I mean, we've spoken to a handful of analysts that have been covering this kind of from the start, Eric and James, to name two people from Bloomberg in particular. And everyone who's followed the Bitcoin ETFs, pre-approval, post-approval, have really all been blown away in terms of their expectations on the success of this product. And Brian, I wanted to hear what you thought just on IBIT now being in the top 20. It's only been around for like 18 months. So insatiable demand there. And then the other piece of information that you had kind of married to this was the fact that Vanguard, talking about boomer institutions, Vanguard is now reconsidering offering Bitcoin ETPs to their client base.
There's a lot to unpack here. I mean, even just looking at the list that we have on here, look at how many times Vanguard is above IBIT in terms of these the largest ETF. So the Vanguard news is one piece that is interesting in terms of them sort of signaling that they might be bending the knee. I haven't seen a ton of follow through on specifics or details there, but it seems like the underlying demand from their end clients likely sparked some movement here. And then also just observing the success of these products. A few months ago, we had the headline that BlackRock's IBIT now generates more revenue for them than their S&P ETF product, which is pretty remarkable. And the broader signal from all of this to me is like, they're the most successful product launches of all time, the Bitcoin ETFs. Despite that, however, the access and plumbing for people to get exposure to these is still very early days. So Tefra Digital has a chart that shows this very clearly in terms of sort of the broadening access to these spot ETFs. And it's still, there's still a lot of restrictions in place. Even if they're approved on a platform, there might be stipulations around which clients can actually get access. And there's typically sort of firewalls in terms of direct solicitation to end clients around these things. So that's the big signal to me, is like, it's still so early in terms of the actual plumbing and people having the ability to get access to these things, but it's still, $90 billion in assets in IBIT, and, the best performing sort of best product launches of all time, really, in terms of just ETFs, generally speaking. So it's just pretty remarkable that you have that sort of dichotomy occurring here.
All right, quick break. If you're enjoying the episode, please leave us a like, a comment, rate 5 stars. subscribe, depending on where you're listening. If you are on YouTube, a comment really helps. You could leave positive feedback on the show. You could leave constructive criticism. Any of that helps. So please, if you can, just engage, take a few seconds, like, subscribe, comment. It helps a bunch. We spend a lot of time to record, edit, distribute the podcast. So thank you very much in advance for doing so. I really appreciate it. Now on with the show.
Looks like Tyler had to jump, but yeah, those were my thoughts.
Yeah, I mean, I think it ties into a little bit what he was talking about, and to tie what you were saying. I think we just have so much room to run in this cycle. I think it just lasts so much longer than we expect, given that the amount of flows, whether it's Vanguard, we talk to RAs all day long, banks, like everyone's still setting up infrastructure. And unless we expect some kind of weird blow off top, and generally blow off tops last, there's usually certain amounts of leverage in the system, or certain deleveraging around counterparty risk. Like, I don't see any of that happening. I think the leverage is pretty tame, that we're going to let these flows come in, which is going to be recursive or reflexive, because then more people and more companies are going to develop structured products, liquidity pools to get their existing clientele into it. It just feels like this is going to last much longer than even next year, which is interesting. And then that's on the backs of what's happening with gold as well. So it really feels like just uncharted territory. And we kind of talked about this a few months ago, about the notion of if there's a sovereign bid for BTC, that changes it. But I think like the canary in the sovereign bid for BTC is just a sovereign bid for gold, because I think it ends up rational. If the largest sovereigns are already stacking gold, I think it gives even more of an incentive, whether it's the US or really challenger countries, to just pick up the digital version of it that they can buy, fraction of the cost. And I think it came out this past week about like how I think gold's market cap moved. Is it 10 trillion? I think it's 10 trillion, some crazy number.
That's right. Yeah.
In the past year. So to expect that if Bitcoin needed to move up to, $1 million BTC, that'd be a 10x from here in market cap. But that's only, what is that in
that'd
trillion?
Be like 2021 probably, plus or minus.
Yeah, so basically double to get to 1 million, and gold hasn't stopped. So point being is like that everything's kind of on the table when it comes to these assets growing.
The other factor too is Jackson. I put a chart in there from Katusa Research on Twitter that shows the market cap of gold, but relative to global assets. This is one of them that shows if gold basically kept pace with money supply. So it's doing a ratio of M2 in 1980 and then 2011. But if you pull up I put a second one just under this that shows the market cap of gold relative to global assets in 1980 versus today. And this is just pretty stunning, because like what we just discussed, gold has been ripping, added 10 trillion over the past year, yet it's still a fourth of sort of where it was in 1980 in terms of its percentage of global assets. So like, it sort of just speaks to what you were articulating, Michael, in that like we are in uncharted territories. There is a lot of room to run for both gold and Bitcoin in this context of, well, they're actually smaller than they were 40 years ago in terms of, their actual capture of global assets.
Are we a gold podcast now?
Yeah,
we might be.
We need to almost all do a podcast group instead of a podcast club, instead of a book club for this Groman Macro Voices pod, because I didn't get to fully listen to it. I want to go re-listen, but it ultimately was just describing all these different touch points relative to why we're just in uncharted territory, and like every mental model is fundamentally flawed, because it's effectively the dollar dying in real time, and we're seeing this happen firsthand with what's happening with gold, what's happening in the Shanghai markets. It's weird. I need to get off of Twitter because the algo doesn't even give you any relevant information. It's just rage bait, because I missed, I guess, the past 2 weeks. I don't know if you saw, I guess Modi from India, Xi from China, and Putin all meeting, and then they were also meeting again. There was 2 different events, and it was one like flexing kind of military capacity, but the other one aligning on the usage of different ways to settle oil. And these are happening like front and center, to showcase the world, like we're moving in this different direction. And so there's that example that they talked through. And then there was another one that was super interesting from a guy that was an anthropologist that broke down in, I want to say 1976, the fall of communism effectively from a human capacity, when you talk about birth rates, and just the different factors that would go in. And communism fell 12 years later. And then he broke down again. He had another paper, I want to say in 2014 or 20, like late either 2000s, early 2010s, effectively breaking down how the U.S. could not retain this like level of power given the amount of capital that would be required to sustain it. And it had like 2021 as the time frame, and it's obviously gone a little bit further. And then he just recently posted another piece. He's only had 3, and he's older now, and it was just effectively explaining like where we're at, from whether it's demographics, capital and debt, to military and industrial power. Like, we're just in a completely different ballgame, and I think that's why we see a lot of this volatility and almost, because the way it was being described was, while this was happening, something happened with like Sydney Sweeney, and everybody was talking about that. It's like we're just like, everyone's like paying attention to these other things while all this stuff is happening in real time. And I think the main takeaway there is that if the dollar is in real time losing reserve status, like everything's on the table when it comes to other assets and their price relative to dollars.
Yeah, for sure. And what Michael was referencing was Emmanuel Todd. I believe it was Defeat of the West, published in 2024. But yeah, what I took away from that, and what Luke has been spot on about for probably a decade at this point, is the fact that you can't really decouple the United States from China and Russia, which are the biggest adversaries of the country, because of the dependence that we have from an industrial capacity to the military. And so it's kind of like this odd situation where the tensions between these countries continue to grow, but it's pretty much like a toxic relationship, because like the tensions continue to grow, but the fact that we depend on these countries for raw materials, for creating a lot of the industry that we no longer have in the United States, we actually can't like initiate any sort of hot war with them, or even just like decouple economies from them without collapsing our own. And so that's, I think, like the left bell curve, the simplification of the thesis. And then the other thing that was interesting that I caught there was essentially Luke's thesis, if you play it out another 2 or 3 years, is that gold overtakes the U.S. Treasury market as the largest percent of sovereign reserve assets. And so at that point, I'm sure if that does happen 2 or 3 years from now, I'm sure the United States will still continue to think that the world revolves around the U.S. Treasury market, but the market has actually decided otherwise. And so does that actually start a conversation around, well, is gold actually now the neutral, yes, it's a neutral reserve asset, but is gold the reserve asset if it overtakes?
Yeah, in that, like, Brian, I'd love to get your thoughts on this, because this is, we harp on it, and I know it gets a little old, but I just can't help, because it feels like we're some of the only people saying it, or me, is about the Treasury stuff. The Bitcoin Treasury is, everything's the same until it isn't. And so if we're talking about Treasuries taking reserve stat, or gold taking reserve status from Treasuries, and, very smart people have been talking about outside money for so long, if volatility and counterparty risk increase in this world, which I think we would all agree, everyone would agree, then it makes little to zero sense to hold a large percentage of your wealth inside the system, because you don't know where the risk lies across a number of different orders. So again, that's the angle of, like, you're taking this asset that is meant to be decentralized out of the system, you're parking it right back in the middle of the financial system, and a bunch of weird things are going to happen, and be prepared for them. And it's not to say you can't speculate, but it goes back to what are you doing and what's your plan? Because if it's speculative asset, well, if you're all in Bitcoin, that's perfectly fine. But if you have no Bitcoin exposure or anything outside of the system, maybe you want to start with a core position before you start to bring it back in and be susceptible to whatever is going to happen over the next 2 to 10 years.
No, 100%. I mean, that's very well said. The other way I would describe it is like, the Treasury company wrapper, or even just the ETF wrapper, effectively nukes a large portion of the value prop of owning Bitcoin. And that's sort of what you're getting at in terms of, if there's a renaissance around, what is money, what is a store of value, what is a reserve asset, holding it in a structure where you don't have the same ownership guarantees or assurances is completely illogical. And so, I think, part of the disconnect in the conversation earlier around Treasury companies is like, it's fine for risk capital, but understand that they are trades necessarily. and you are fundamentally just getting a different, you're getting some price exposure to Bitcoin, but you're not getting any of the other benefits that make it a reserve asset. Its price appreciation is not the reason that people are adopting it as a reserve asset. They're adopting it because you can hold it without counterparty risk. They're adopting it because it can't be diluted by a government. They are not holding it purely for the price appreciation. And I think that is not well understood at all, just given the uptake and the narratives and the hype around these treasury companies that we've seen. But it is, if you just go back to first principles around the merits and the core value prop of this asset, by putting it in these wrappers, whether it's the ETFs or the treasury companies, you're stripping away a lot of that core value, the reasons why you would even want to own an asset like Bitcoin in a portfolio.
Yeah, and I think there's there's so much embedded in all of this when it comes to the asset price doesn't happen again in a vacuum. As the price appreciates, that other people are buying it, other people are recognizing what Brian just said, and then they will start to demand goods and service be paid in that. And so you may want the underlying as it appreciates because you may naturally want to spend it, or you actually may be required to spend it.
Right.
There's a lot of pretty out there examples, but I remember back in the day, there was a client that came to us. They needed to set up, without it being publicly known, a meaningful Bitcoin position from a business continuity perspective around cyber attacks. Because naturally, when cyber attacks happen and they steal data and they ransom it, they don't want bank trails, and they want you to pay in BTC. Now, obviously, that's very on the far end of the spectrum, but there will be increasingly reasons why people will want to accept Bitcoin as the price appreciates. And if you don't have any exposure, and it goes back to, well, why would you want the underlying is there's a value prop in the censorship resistance. There's a value prop in, the custody aspect, but there's real value in optionality. That's the purpose of money, is to give you optionality on what you do with it in the future, but also how you do with it what you want. And you can't eat your equities. You can't do any of these. Nobody's going to take your MSTR shares if, you need to spend them on something. And so, again, I think this is we're so early. There's so much education, but it's going to happen, I think, faster than people recognize, because once some risk happens inside the treasury company craze, people will start to understand that. And then also, as counterparty risk and more merchants and people just naturally will accept it and incentivize people to give them their Bitcoin, they're going to be like, well, why am I not holding this? Or I should figure out actually how to have a small cornerstone position in a similar vein that this business had for their continuity purposes.
Yeah. Just be patient, Michael. It may be a decade, but it was similar to that Luke Roman podcast where Eric, the host of Macro Voices, said what Luke would say on the podcast 5 years ago. People thought he was a nut job, and now all those same people are saying, well, shit, he's actually right. So if you just be patient, wait 5 to 10 years, you might be
Michael,
right.
Just be patient, man. All right.
Did you listen to the whole pod, Jackson, or you listened?
I didn't make it through. I listened to a bit this morning.
It was probably one of the best I've listened to, because not in a good way. It was just really breaking down in a very pragmatic, we're headed to a very weird spot. And it seems to all kind of be converging right now. And yeah, it's not, yeah.
Yeah.
You might want to.
It'd be a lot weirder if we didn't have Bitcoin, though, is what I would say.
Yeah, we'd be cooked.
We'd be big cooked.
Yeah, I guess that's the challenging thing is, it really does tie into wanting to have wealth outside of the financial system, and that would even go beyond just owning Bitcoin or gold, right? You probably would want to own land. Maybe some people want to actually raise their own food, but I think it's kind of the broader theme, the really macro theme over the next 20 years would probably be moving away from just measuring wealth from numbers on the screen, because the numbers on the screen, they can go down in nominal value and then get destroyed in real value. They could be confiscated from you. And so that's where that probably goes longer term. And that's kind of I guess what you're saying about, things get weird or things get scary.
Yeah, and that's the main reason I brought it up so many times, and I'll bring it up again, is watch Cinderella Man, because it's a good flick, but it's really a documentary about the Great Depression, because all of these people lost all of their money And it brings you to a real visceral place of like, oh my God, what happens if all the numbers moved off a screen? Because it actually happened, albeit it was about 100 years ago. And so we're just so far removed to realizing that can happen. And we should, post-COVID, realize that anything can happen, because everyone before that would have said nobody could get locked in their house and all the things that happened post that, and they did. And so I think it's just still discounted that volatility will only increase from here, because basically the dollar as a world reserve currency is failing. And so you just have to be prepared for that. And being prepared for that isn't putting money into the financial system and having a gatekeeper.
All right. Well, what do you have to say?
No, I was just thinking about when's the position time to take a little bit into gold, just because I think you might need a little gold in the future, Jackson.
Yeah.
You missed the levered long back at 58 or 60 too, because we're sitting at like 120 right now.
Yeah.
Price dipped a little bit, and Jackson kind of had weak hands on the terminal.
Did you say 750 by the end of the year, Michael? I think, if I'm remembering correctly, that was your price target 6 months ago.
End of year is hard. I think end of cycle. Whenever
There's no
we
cycles,
kind
dude. Cycles are over. There's no more cycles. Come on. What I think is going to happen in the next few months is we're going to get a run up, and people are going to think it's the top. People are going to think it's a blow off top at like 150, 160, maybe even 170. Then there's going to be a head fake down, maybe back to like 125, and then into next year, bull market continues.
I think
most people are totally sidelined as a result of the head fake.
I think most people are sidelined right now.
Well, that's true.
What I think is the most interesting is how Groman said on the pod that he came to Bitcoin because he understood it as a currency problem. Because everyone talks about, even earlier, we were talking about Weimar as being some like really ephemeral thing. But like when you look at gold or Bitcoin versus the dollar, it looks exactly like that. And we're still in the early stages, and there hasn't been this amount of devaluation in the dollar. So yeah, I think we end up, even in your world, which you shared, Brian, I think it ends up at higher numbers, because whether it's now, or it feels like it's going to be now, because there's just been this chop for the past 9 months. There's too much capital pools sitting on the sidelines that we know want to come in, whether it's institutional capital, the Treasury stuff, the sovereign,
or the U.S. government. Yeah,
the U.S. government. And between gold doing what it's doing and this, it's just, I don't think we're prepared for like where, and it could be, we could be wrong. Like there's the whole gradual and suddenly, and it could take much longer, but it doesn't feel like that right now. Like the amount of chaos being churned up in the traditional kind of news cycle and what's happening. We saw the only time we've seen this happen again was like post 2019 when the repo markets broke and we just like all hell ensued in 2020. That's what this feels like, that the chaos is getting ratcheted up because the system is just starting to like crumble.
Certainly feels like Weimar in many ways.
And that's what, you feel it when you go out, when you look at, it's just crazy. Like when you go interact with the normal world, I limit that, but when I do, you kind of hear these stories. I just remember sitting the other day at the like pumpkin patch, and they were like talking about concerts, and they were like, these weren't like.
Hang on, I didn't know you went to pumpkin patches, Michael.
I don't, but I have to like, once in a while, kind of, do the.
Gotta hit a patch.
Do the fan card.
Fire off a patch.
Fire up a patch. But they were just talking about like going to concerts, and they were like, imagine the everyday person can't afford this. And these were like everyday people in my mind. They weren't like, so they're just referencing like that people can't go to concerts, and like they're all like and it wasn't even expensive, I guess, relative, but it was like if you go with your family, it's going to end up X dollars. So it's not really achievable. And you look at the groceries and you go buy any meat related product, it's not. And maybe the last thing is all those charts are like, I don't know, I can't help but feel they're the version of Fed speak when you see post 21 and that like stock market, the chart we pulled up earlier where the stock market went vertical and then the jobs declining. Like, I think that's a component of interest rates, not necessarily productivity, but interest rates being, rising. So naturally, people were laid off. But then also when you look at the job, like recalculation of numbers, and it goes back to GDP growth has been measured in the wrong underlying currency. So it looks like we're growing, but we're not. And we've basically been in a recession since.
It's also been wildly manipulated by government spending and government jobs being a large bulk of any proverbial job growth.
Exactly. So we're like at a true sense of like gross new product, you can make the case like post 71, we've been effectively in a recession because there's been more monetary units than actual productivity that's been created. And that's why you see the world what it is today. It goes back to the whole tweet of like your clip or whatever. It's like we were promised flying cars and whatever. And all we got was like 240 characters. It's like that's why we're sitting here with the same shit because there's no actual productivity happening. There's just people talking about treasury companies and all this other bullshit that produces no real value in the world. Like that's the crux of it. And everyone's incentivized to go deliver no new value because they can game the system to extract more dollars. Once all these concepts get back and understood, that's when you gotta get the real renaissance. But it's just gonna take time.
Pulled this up on another pod, but there was also that tweet that was basically saying like 75% of stock market gains are from AI related stocks. So a lot of that's probably NVIDIA, but like that I think is also an explanation for that chart that we had up that shows the stocks going up despite, the real economy suffering. Is it's being propped up by people just chasing this hype cycle. And, what have we gotten out of it thus far? Like, just this week, OpenAI put out their Sora app, which is basically a TikTok competitor that is just purely AI slop videos. Benefits to society, probably negative, generally speaking. So like, all of this money chasing this AI hype cycle remains to be seen what comes out on the other side of this. And so a lot of capital will be destroyed in this process. And should get pretty weird.
Maybe the one thing like to tie it all back to positive is this is really where it goes back to the whole, I think it was Ford earlier about savings. If you finally get it right, it doesn't even have to be Bitcoin, but if you end up in gold and you feel relatively good that you are going in real terms to maintain your purchasing power, then everything we talked about and we're focused to pay attention to because for sick, ways, either because we're interested in it or because of the business and doing these podcasts, you don't actually have to pay attention to any of it. You can just go back to living your life. But if you don't decide to do that, then you're effectively on the hamster wheel of trying to make ends meet, whether it's with your job, not quitting, not having wealth saved. That goes back to the optionality, but then also being glued to Twitter and these screens, trying to figure out what's the latest DAT and the crypto and like whatever to get into, versus just like opting out by protecting your wealth. And then you just get your head back because you don't have to pay attention to this. And if you decide to pay attention to it, it's because you're just a perverse individual versus, it's just, there's a level to get back to normalcy. And it just means you just protect your wealth. But until you realize what we're talking about, people just are going to end up playing the real versus nominal returns. And they're just going to get absolutely crushed because the risk lies everywhere in that world.
Yeah. Well, I mean, it's also what Tyler said too, where it's like, and it's what you're saying as well, where most people would rather just be in something they perceive to be comfortable and safe, even if they know they're still like not growing on a real basis. Like most people haven't actually came to that conclusion yet, but still, Michael, it might be your point where a lot of investors or savers are comfortable owning bonds that are not going to actually grow their wealth. It's actually going to lose wealth over time, then own something they perceive could just like blow up one day, right? So I think we still have a lot of work to do. We'll probably have to do the last trade at least for another decade or so. Then we can see if any of this plays out the way we think it will.
Maybe Jackson will get a house by then. Maybe he'll get a house in a decade. We'll get art.
I'm in a cave, but Tyler said the cave was nicer than whatever Michael's got going on there. So if you like where I'm recording from in the cave, I'm like Bin Laden.
Off in the comments.
Just like leave a like, leave a comment.
We need to call out Jackson's paper hands because the price dipped a little bit and he just stopped with the terminal. This used to be his favorite chart. He'd pull it up and
we had ripping, boys.
We had this little clip down here, or maybe I don't even know. I guess this is
it was probably like 2 months ago at this point. I haven't done it.
It was somewhere down here where it just got depressing, and Jackson was like, well, "We're gonna end the chart," but we're back.
120. All right, I guess I do have paper hands. I sold all my Bitcoin. All right, I guess we'll call it. We'll call it a week. If you like the internal riff at the end of the episode, maybe we can make this a standard. But we'll have to hear feedback if people actually enjoy it, and let us know. If you don't enjoy it, you can let us know as well, because then we'll save your time, we'll save our time, and we won't do this anymore. So thanks for tuning in this week, and we'll see you next week, maybe.
Thanks, fellas. Thanks for listening to this week's episode of the show. If you found the information valuable, please share the episode with a friend or leave a rating on your favorite podcast app. All the links we discussed in today's show will be in the show notes inside your podcast app. Before we finish, a quick reminder that OnRamp Media is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Regardless of where you are on your Bitcoin journey, we'd love to hear from you. Visit onrampbitcoin.com/contact to schedule a consultation with one of our private client advisors.